It was in the beginning of last year when I really felt that LPs I was talking to, also big insurance companies, pension funds, etc., that they walked away or that they were more hesitant of deploying in climate tech because they were nervous and they were intrigued by the global narrative. I'm Lea. I am with KfW Capital for 5 years now. We have this huge funding gap in Europe from Series B onwards. I think if you really work with the fund, talk to the funds, you realize it's just a vertical or a sector you're investing in, and it has nothing to do with philanthropy or so. Yeah. It's just part of the investment strategy that everyone should have.
Lea, welcome to the podcast. Very glad to have you in Paris while you're, just for a short stay, but was able to catch you during that time. Today's conversation will be about how LPs make decisions. I hope we can get behind closed doors and see a little bit what's happening at KfW. Want to understand what separates funds that gets funding and those that don't. How to improve your fundraising process. Hopefully that serves as a tool for fund managers. And, something that I hear a lot of people talking about right now is like Fund 2, specifically in climate. So how to approach fundraising for Fund 2, which I think is quite different. But before all of that, Lea, can you please introduce yourself?
Sure, happy to. Yeah, thanks for having me today. It's a beautiful day in Paris, so happy to be
Fantastic
here in person. I'm Lea. I am with KfW Capital for 5 years now. Before that, I was on the direct investment side with a PropTech VC in Cologne, and then I switched sides to the LP side of life. KfW Capital was founded in 2018, so not that long ago, and I joined in 2021. And within my team, I focus on climate tech, impact, and deep tech investments.
How have you found the transition from being a direct investor to an LP investor?
Actually, for me, it was quite natural, and it really helped me understand how GPs work. So for me, it was relatively easy to switch sides. And I also thought in the beginning it would only be like for a certain time period to be on the LP side and then switch sides again. But actually, I really enjoy being an LP and working with so many funds. And I really like the work.
Do you think LPs would make good GPs actually?
I think this is harder than the other way around.
Yeah, okay.
Because LPs are more like on a higher level, and GPs really have to be quite deeply into the topics. And I think I never met so many person changing sides from LP to GP. And I think the other way around is more natural.
Yeah.
But of course, there's also LP starting co-investments, and then you have both. But still, co-investments is a bit different than GPs that really...
You don't do any co-investments with KfW?
We do.
Okay.
We started last year. We have a dedicated team for that.
Okay.
And we started to invest alongside our funds. Yeah, we're just starting the program. It's a 1 billion program, so we have lots of money to deploy. But yeah.
How much of that should go to climate and impact?
We don't have a fixed allocation, but I assume that because we only invest if the rounds are big enough, and I think deep tech and climate tech rounds are the ones that require lots of funding. So I think there might be lots of climate tech investments in there. Yeah.
And what's the idea? Is that you want to co-invest with your fund managers? Is that the plan?
Yeah.
Okay. So basically, they come and they say, "Hey, we have this Series B, C, whatever company. They're raising 100 million. Do you want to come in with us?"
Exactly. Yeah.
Interesting. Does that kind of diversify your portfolio? Or concentrate your portfolio? I'm not sure how to think about it.
Yeah, and I think it concentrates it. But of course, it also, because we have this huge funding gap in Europe from Series B onwards, and this mandate is more, to close this funding gap. But of course, it concentrates the portfolio in some cases. Yeah, but our portfolio, I don't know how many direct investments we have, or indirect portfolio companies. I think it's 2000s or so at the moment. So yeah.
Yeah. Okay. So you're already quite exposed to the ecosystem anyway. I'd be curious to hear about the performance of KfW, but Look, let's first talk about the state of European climate tech. You mentioned something already which is quite interesting, which is the Series B gap and onwards.
Mm.
Is that still the case today?
Yeah, I think it's still the case,
Mm.
but and we see more and more like growth stage investors or platforms coming out. Also, early stage investors that are now raising next generations that are more multi-stage focused, or funds that try to raise bigger funds to be able to have more reserves to
Mm.
follow the investments also in the later stages. But still, I have the impression that it's a big funding gap.
How long does it take to fix it? Because it feels like I started this podcast a year and a half ago, and it feels like the first LP conversation I've had was, well, we need more funding for growth stage companies in Europe. It's been a year and a half. Feels like it's not changing fast. Like, how
Mm.
long do you think it takes for fixing that problem?
Yeah, that's very hard to answer, but I think it takes definitely longer than you might think it takes.
Yeah.
Also because the market has changed, appetite for climate or
Mhm.
impact investments also decreased. So on the one hand, you still have this funding gap, but on the
Mhm.
other hand, you have LPs and investors that kind of stepped out of the market, or they are more fear driven, and
Mm.
this also does not help the issue. So I think it still will take some time, but we should all work on it.
Yeah, of course. I think the success of the European climate tech ecosystem depends a little bit on it. Although I feel like US investors are very generous when they see great companies
Yeah,
out of Europe, right?
true.
They don't shy away from investing in our companies. Um, you mentioned the kind of, you know, the, how can I say, the sentiment around climate tech in Europe is going down, and impact as well. um, I don't talk to so many LPs. I bet that you talk to more LPs than I do. Is that really something that you see across the table, across all the LPs that you talk to? Do they kind of shy away from impact and climate right now?
Yeah, so I think it was in the beginning of last year when I really felt that LPs I was talking to, also big insurance companies,
Mm.
um, and pension funds, etc., that they walked away, or that they were more hesitant of deploying in climate tech because they were nervous and they were like intrigued by the
Mm.
global narrative, etc. But I think now it's progressing and the market is maturing,
Hmm.
and so do the LPs. They kind of see that there's still solid climate tech funds, and also, I mean, the storytelling has completely changed. And if you really look at the funds and go through the portfolios, and then you see that it's really investable,
Hmm.
and that it's not about impact anymore or investing in good people that do good things for the world. It's really an investment thesis.
What do you think makes them come back to climate tech? Like, do you see, and maybe that's where we have to talk a little bit about performance, but I'm assuming that LPs are just like rational finance people that look at numbers, right?
Mm.
So the fact that they're coming back, does that mean that we have great performance in climate?
I think it just needed some time that the big panic wave around climate and impact went away, and
Hmm.
it cooled down a bit, and people that pressed on pause before just started to look at the funds again and to continue conversations with them. And I think if you really work with the fund, talk to the funds, you realize it's just a vertical or a sector you're
Hmm.
investing in, and it has nothing to do with philanthropy or so.
Yeah.
It's just part of the investment strategy that everyone should have.
I love to hear you say it because that's one of the key things I'm trying to push on this media, which is like climate is not philanthropy. Like for
Hmm.
me, it is one of the largest opportunities that we have, especially now at a time of AI, where like if you don't invest in some of the big AI companies, the rest, like
Hmm.
software and everything, is not quite defensible. And now you have this big climate stuff that has big, massive hardware that has lots of capex, but is very much required for the world to function properly. And by the way, it's very defensible because it's not like you can't snap your finger and prompt your way into like a fusion reactor. That doesn't quite work out. So, I mean, from my perspective, I think it's one of the largest opportunities that we have.
Yeah, true, definitely. And I think this is also what is really important to educate the LP market or the investors market. So therefore, podcasts like yours are really important. And also that big institutions like we are or big public investors act as multiplier for the private market, and to show that, because we're also return oriented. We're not an impact investor at all. So our main goal is to generate returns, and we don't differentiate between like climate funds and other funds we invest in, because we have a large portfolio and we invest in pretty much everything. So, and climate is not like our impact or our philanthropic impact on the society. It's just an investment, or it is an investment sector and vertical.
And do you have like a target at KfW level for returns, or is it like per vertical?
No, not per vertical.
Okay.
We have like an internal target. We have like an internal scoring where we score the funds that we're looking at, and they always have to be above a certain threshold with regards to DPI. And then we can invest. If they are below, we never invest.
What's the threshold?
I think I'm not allowed to tell that.
Okay.
But this is what we look at throughout all the sectors.
Okay, interesting. I love that you have the exact same threshold for everyone.
Yeah.
That sets the stage for what climate really is. You talked about some of the sectors being more investable than others. What have you learned the last, 3-4 years in climate? Like, what are the things that are working super well, where you think companies are making a great job, and parts where we probably have mistakenly invested in sectors that were not, profitable, I would say.
Yeah. So I think this is actually really, really interesting, especially for me, because I started in 21 at KfW Capital, and this is where most of the first wave of climate tech funds raised their first funds. And now, 5 years after it, the world kind of completely changed. So we backed a lot of the first generations of climate funds in Europe. There were also lots of German funds. We looked at all of them. And for us, it was also quite new. Also, KfW just started in 2018. Then we started in 2020 or 21 to invest in climate funds. And it was a completely new field for us. And the narrative changed a lot, but also the investment strategies. In 21, lots of climate funds also invested in alternative protein, for example. And the entire food tech and agri-tech market did not really develop well.
Yeah.
And this is something I think lots of funds adapted their strategy throughout their investment period, but there's also lots of funds there that are still exposed to that sector. And I think there's no fund now coming out to the market raising for food tech or alternative proteins anymore. I think there is maybe some, but it depends, because it's not like that. I remember 5 years ago when you talked to the funds that were really invested and pushing for alternative proteins, for example, you kind of believe that 5 years from then, nobody would eat meat again. But this actually did not happen. So it's still a tough market, but there is some companies working well. But this is something I would say was not a fail, but it was like a vertical that did not work that well or not as expected.
Do you think that's because of, my perspective on it is that because this is the only or part of the sectors where we basically have asked consumers to say, hey, you have to make a choice. Do you want to be climate friendly or not? Whereas, I don't know, if we talk about energy, the goal is basically to get energy as cheap as possible. And by the way, the green energy is becoming cheaper than oil and gas. And so that's where we're moving. So we're not really asking for a choice. It's the same product in the end. It's energy, it's electricity. The price and how you build it and how you produce it is different. Whereas for alternative proteins, for example, I think it maybe would have worked better if like you go through the B2B way and then consumers are not quite aware. I have an example of that. A company that one of the guests I had on the podcast had invested in was alternative chocolate. They put it in cookies. people didn't really realize that the cookies were not made with proper chocolate, and then it worked out super well for them. Whereas when you ask for alternative protein, usually you think through, plant-based meats, and then you ask people to make the choice. And I don't think people care. That's a problem.
True. Yeah, I think so too. I think the companies that were more on the B2B side, such as this chocolate alternative, that could work out very well, or did work out in some cases. But if you're on the B2C side, it's quite hard. Also because you have lots of alternatives. If you go to the supermarket, you see lots of alternatives. But as long as, for example, in Germany, you can buy like 1 kilogram of chicken for $6.99 or so. And we have like huge inflation at the moment. People would always choose this. I think it's a different maybe in France, but in Germany, they choose the meat instead of the 100 grams alternative meat alternative for $4.99 or so. So it's simple maths.
Yeah.
And also it's really hard for the startups to get into the supermarkets as well. So scalability is also very difficult. And I think this is also the case. And in terms of crises, people don't care about what they eat maybe. So they just eat what they can get and what is cheap.
Yeah, I agree with you. And also I think the climate narrative is probably not in our favor.
Yeah.
As I said, I mean, although I'm quite an optimist, I don't think a lot of people care enough, at least, about the climate. On the other side, what have we done well? What are the sectors where you think, okay, we should have doubled down on this from the beginning because this was quite profitable in the end?
So I mean, profitable is still it's still a big word because most of the companies are not profitable now. But everything around the energy sector, of course, is really, really important. This is also what you see in the climate tech funds. They're really focusing on energy right now because the energy demand will rise massively from year to year, also with AI. So I think this is where most of the funds are now going to.
And what were some of your criteria when looking at funds in 2021 that you think were the wrong criteria to look at?
This is also very hard to tell because, of course, when you invest in first-time managers, you take a lot of risk. But I also think that institutions like KfW, like public institutions, should also be there to take this risk and to support first-time managers, to support innovation, and to also signal through the DDs that we are doing, which are very, very decent and detailed, that you can also invest in first-time managers. And me personally, I really like the spirit of first-time managers. But of course, you have this higher risk because it's often people coming together with different backgrounds. And most of them did not have that many experience in the climate tech space because it was kind of a new space. And therefore, you really had to trust, or you had to just give them some credits before they even delivered, which is now different because 5 years afterwards, they could prove maybe their strategy or also that they invested within their strategy. Performance is still very early to tell, but now it's a very different way.
And how do you think about then second-time managers? I think we're getting into this phase now where basically this batch from 2021, like if, when you go to conferences, everybody's raising money right now because, obviously just like VC cycle, right? They've raised 4 or 5 years ago. They've now deployed most of the money and they're raising again. As you said, most of it doesn't have any performance. I'd love for you, first of all, to explain what performance means to you and then also how to raise that second vintage.
Yeah. So this is what we actually experience at the moment because all the funds we invested in 2022 are now coming back to us to raise the next generations. First of all, of course, for most of the funds, the narrative completely changed. You also see completely different pitch decks from impact for the world to resilience for Europe. It's a very different narrative, but still the underlying investments are kind of the same. They just evolved a bit, as I said, like food tech is not that hot anymore. I'm more shifting towards energy tech, industrial tech, etc. But now it's really important that the GPs show, because there's almost no DPI for all the funds we are looking at.
Have you had funds where you had DPI already across your portfolio?
I don't think so. And if it was very, very little, so it did not move the needle. Also because most of the funds were invested in our early stage. And of course, it's very hard for early stage funds to pay back lots of money after like 3 or 4 years. So most of them don't have any DPI. But what you can see is when you go through the portfolio, you really have to dive into every single company and to see the traction they have. And therefore, it's really important to engage with the fund. Also, throughout the investment period, before they raise, it's always easy if they are really transparent about the portfolio. And what is interesting is sometimes you're surprised because there is companies marked at 1x in the portfolio, and the last funding round was 3 years ago, and you're saying, oh, why they are not raising? It's 1x. Is it a good company? And then they tell you, oh, they're on their way to profitability this year. They don't need to raise any money, but we could not mark up the company because there was no funding round. And this is something that LPs want to hear. We need to understand the unit economics that are underlying in the portfolio, and to go see if it's a healthy portfolio, and what value really is in the companies line by line.
What's the best practice there? Do you want your portfolio managers or fund managers to send you quarterly reporting with every single details? Do you want them to call you from time to time? What's kind of the best practice to entertain that relationship all the way through? Okay, we're now raising again. You've got all of what you need, basically, right? To make it a quick decision, basically.
Yeah. So we get the quarterly reports, but it's rather high level then. Some of the funds do also quarterly update calls with their investors, which is really interesting. But I think the most important is for me when it comes to fundraising that they have their data room prepared and they have documents prepared that show line by line the traction of the companies. And then you do a call with the funds and go through the portfolio. And this definitely already helps. Yeah. So they don't have to work on it for 2 years or so. Just at the point that they're raising, they have to show what's in the portfolio and how they look at it and being really transparent about it.
Do every single LPs that look at the details to that level? Because, I sometimes have the impression that people are saying that LPs are basically writing checks based on people and looking at the overall performance, but not really looking line by line every single company and understanding the performance. Do you think everybody does it the way you do it?
No, I don't think so. But this is why we're often also seen as a reference for some of the, especially the private investors, because most of the LPs don't have the capacities. They have small teams. They sometimes also invest across all asset classes. We only do venture funds, so this is our core business, and we have a big team to do our due diligence. So therefore, I think it's really rare that other investors would do a due diligence like we do it. But therefore, we do lots of reference calls. Especially, this is what I find interesting, because in the last months, I did so many reference calls like never before. But what is good, because if people rely on our work, it's a good sign. And this is actually what we're here for to...
So you mean people calling you to invest in your funds, basically?
Other LPs calling us because they want to invest in funds we invested as, and they just want to hear our opinion about it, or double check if their due diligence is
correct.
Is correct, yeah.
And so what you're saying is that basically when you're raising the second fund, it's not like I need to have a certain level of DPI, because you said most of them don't have DPI anyway. Is that also true, by the way, of non-climate tech fund?
Yeah, it's the same.
It's the same across the portfolio.
It's the same. Yeah.
Okay, that's good to hear. That we're not the bad the bad students, right?
No. Also, when you look at our portfolio, you see that the same vintages across all sectors have almost the same performance. It's not that climate tech underperforms the other vintages. We could not say it. Of course, there is some climate tech funds underperform others, but like in general, the average is pretty much the same, I would say. Yeah.
And I would probably assume that it's the same across all sectors. You would have, I don't know, education tech funds that are also underperforming versus others.
Yeah.
Okay, so it's not about DPI. Do you care about TVPI at that stage? Like,
yes, yeah, because this is something you can see on paper
yes.
to move on. Then, if you don't have DPI, you have to look at the TVPI.
Can you remind me of the meaning of it?
Total value to pay it in. It's like the value of the invested capital right now. It includes the up rounds, for example. And this is what we're looking at, because if the fund is, for example, to give you a broad range, when it's a vintage of 21, 2022, it should definitely be above 1x TVPI. So it should be out of the J curve. So this is already a good sign, but still it's all on paper. So you cannot rely on the TVPI, but you have to take something into account. You have to see something to move on. And then you dive deeper and you see, okay, the TVPI, if it's above 1x, what drives this TVPI? Is it only one company that had a big up round and the rest is still at cost? Or so this is the portfolio work that I just mentioned that you have to do then.
You said above 1x, but what's your reasonable expectation for a fund from 2021?
It's hard to tell because it's always a case-by-case decision. And for us, it's more important what is in the portfolio, what companies. Do we really believe in the companies? Do we think they did a great job and they delivered on their strategy? This is more important than when I say the threshold is 1.2x or so. Yeah.
Okay, yeah. And also, I think there's a bit of narrative around it. For example, if you have a big exit events coming up, I don't know, one of your companies getting acquired in a couple of months or something like that. I think that's part of the story as well.
This is also really important information. And sometimes I'm also a bit surprised when I talk to the funds we're already invested in and they come to me and say, yeah, we want to raise the second generation. What is important for you to know? And some of them seem surprised that this is important information and that I have to pull it out of them. But this definitely helps if they can tell me, yeah, we have some companies that will be acquired later this year. It's already a good sign.
So for Fund 2, you still can run away a little bit with a narrative and storytelling. You have a little bit of number, don't get me wrong, but like the narrative still plays a very important role. Is that narrative based on the future also? Like, do you also look back on like execution? Because for example, you said they could invest in their thesis. Have you seen cases where it's not the case?
No, not really. So actually, most of the funds we invested in the first generation kind of delivered what they promised in terms of strategy. And this is actually also one like ticking point because this is really important that you invest what you promised once. The other important point is also team, because as I said earlier, investing in a first-time team is also a big risk because there's people coming together that maybe did not work together before. Some of them did, but some of them did not. And for us, it's important to assess their dynamics and how the team evolved and are they still working together. And this is also an important point. And there it helps because you build the relationships. You are talking regularly to the team. You get lots of references also from the crowd, from the ecosystem. And this is something really important to also take into account.
Do you talk to founders as well? Do you ask them like, is that a good investor?
Yeah, that's what we do. This is actually a big part, and it's a really interesting part because sometimes, of course, founders would not really talk bad about their investors, but sometimes you really hear and feel there's some differences. But this is really interesting and also important, and especially when assessing a new generation, it's important that the founders really believe in the investors and think I would take their money again and
Okay.
again. And I also recommend it to my founders' friends because they add great value and it's good to work with them.
Yeah, that's probably also one of the key leading indicator to performance for the next fund as well, because founders have founders friend, and then
Yeah.
they will recommend those friends, and then at some point you get the perfect, amazing company that returns your fund basically
Yeah.
through that network. Okay, so we have a little bit of paperwork looking at your numbers. We have reference calls with founders. We have team dynamic relationship. What else is included in that kind of due diligence process for funds?
So actually, the follow-on investment follows the same due diligence process as before. We do always the same long process that we're doing,
How
but
long is the process?
depends. I would say from 3 to 6 months.
Okay.
But when we first engage with funds, it can take even years from first contact. You have to be patient with us. But I think for a follow-on investment, always depending also on the legal stuff, etc. If there is lots of changes, but 3 to 6 months, I think, is a good number.
Okay, and 3 to 6 months, you do your due diligence. What happens during that period of time? Going back to what we were saying before.
Yeah. So first of all, I think the first step we're doing is the performance part, because also for us internally, we have to do prioritization of the funds we invested in. We have a fixed budget. We have a huge fund portfolio with re-ups, but we also want to do new relationships, new funds that we invest in. And therefore, we start with the performance. We go through the companies, as I said. And if we find, okay, it's investable, it's a good fund, then we start looking in, is there any changes in strategy, in the team? How did they develop? What is the strategy? Also in terms of fund size, do they want to increase the fund size? Why why so, etc.
Should you always increase the font size? I feel
No,
like
I don't think so. It depends if your strategy also kind of changes. If you think that you see more late stage opportunities, for example, where you need bigger fund sizes and bigger checks, sometimes it makes sense. But if it worked out for you with the fund size you had, you should not. So as an LP, you don't expect to have the fund sizes increasing every generation. But it's always a case by case.
Also because your pockets are not getting larger and
Yes.
larger. So if you have to
Yes.
double down on every single fund, then that doesn't work out for
Exactly.
you.
Yeah.
Okay, so fund size, portfolio construction, track record. I think we've mentioned about everything you're looking at, or am I forgetting something?
Governance and team development. Not sure if you mentioned it, but of course we also want to see, depending on the maturity of the fund, but how is transition managed? How is the development of the junior people? Do they have an outlook to become partner in the firm? This is also really important because we see us as a long-term partner, and we always see it like more than one generation that we want to back, and therefore we really also track.
Is that always a strategy? You invest in a first-time manager, or like in the first fund of that specific fund manager, and then you want to back them throughout the journey? You expect to back them throughout the journey?
I would say what is rather, we really like to be long-term investors, but we don't say that if we back funds one time, we will back them again and again, because it always depends, of course, on their development and performance. Yeah.
Okay. How do we improve that fundraising process? In other words, as I said, you're seeing a lot of funds right now from that first climate tech vintage. As part of that, I'm sure you see some people that have the fundraising process fully figured out and it's perfect, and somewhere they need a bit more help. What are your pro tips and tricks to improve your fundraising process as a fund manager?
So you mentioned earlier that other LPs are more like seeing their investments as people business and investing in people. And we do really a big like large due diligence, but it's still a people's business. And therefore, relationship is key, I would say. So even if you're not raising, try to invest time in the relationship also with the big institutions, because people have to have you in mind also when it comes to internal strategy sessions, etc. If you know that there is funds 1, 2, 3 that want to raise later this year, you have to have them in mind, because processes are very long at KfW Capital, but also in other big institutions. So invest in relationships, have regular catch-ups, be really transparent, and be authentic.
Transparent meaning you share the
highs and lows.
Highs and lows.
Yes. Also, be also transparent about the lows in the portfolio, about your lessons learned, because in the end, it's still also people's driven, and people have to convince people, and you can do it with authenticity, I think.
Yeah. How much do you appreciate when someone comes to you and say, "Hey, like I've messed one up. I'm sorry. I've learned this and this." Like, how much does that play in your investment decision for the next fund?
So if they already proved that in the beginning they messed up, but then they changed their strategy and then they showed that they really improved, it's a very good sign, because they can really learn and make the best out of it. But if they say, I totally messed up the strategy and my entire portfolio is like looking really, really bad, then you cannot invest in the next generation, of course.
It's interesting how much similarities there is between LPs, GPs relationship and GPs to startup relationship as well. And you probably have seen that yourself, actually.
Sure.
Would you say it's quite similar?
Yeah, similar in terms of the people's business, I would say. Yeah.
Which is quite interesting for finance, part of finance or an asset class, right? Because I don't think it's quite the same for other parts of finance. There's something I want to talk with you about, which is when I was chatting to a few funds recently, a few of them have mentioned that they have basically locked in quite a great part of public money. So KfW, EIF, BPI, whoever else, TESI. But then there's this rule, and I don't know if it applies to you, which is like matching it at least with one-to-one with like private money. Is that the same for you?
Yes.
And some of them are actually struggling, and they're thinking of like downsizing the fund because they have, let's say, I don't know, 60 million from public funding, but they know they can't get 60 from private capital. How do you get there basically as a fund manager to convince private capital as well?
Lots of funds are facing these struggles, especially because there is DEIF, BPI, TESI, KfW that have really large pockets to deploy in the market. But on the other hand, we have these insurance companies, pension funds that are really under-allocated in VC in Europe compared to the US, for example. And when I'm talking to them, you really feel that there's still not that huge appetite, and they're still kind of under-educated. The asset class is really new to them, and there's like a big lack of private capital in the market. Also, family offices that they have like sometimes a tiny allocation for VC funds, but most of the rest of the money is going across all asset classes. So this is still, I think, a problem we need to fix in Europe. And I think also that funds should really focus on private capital and should not take all the public money only because it's easier to get.
Is it easier to get?
It's sometimes not, but sometimes I'm surprised that there is so many public institutions already in it. And for example, we only invest in funds when they already showed that they have private traction, because in the end they cannot match our ticket, and then we have an issue. So we first want to see private money to be in the fund, and then we can match the ratio, not the other way around. So if we would invest in the first closing, for example, there is the risk that there's not enough private capital coming in.
What happens if that's the case?
Then we cannot sign the whole ticket. So even if we committed 10 million before and they did not match the public-private ratio, they can only like draw the amount. Yeah.
Okay. Interesting. How do we encourage this pension funds, family offices, everyone else to invest more in VC?
Yeah, so this is actually what we're aiming for, is to signal, to bring the signals. And we also doing this because some years ago we raised a fund of fund at KfW Capital, which was a 1 billion fund of fund, where we also wanted to like engage with the private investors. And this is actually private money that we invest from mostly German institutions. And
so that's a separate pocket.
It's a separate pocket. It's a private pocket that we also invest. And this is kind of our attempt to bring more private capital to venture capital.
Interesting. Are you the only government-backed LP that has this double kind of private pocket and public pocket?
I don't think so.
Okay.
But I'm not aware of the other programs. But we are currently raising the second fund of fund, also with, of course, institutional money and private money, and I hope it will turn out well.
So you also have the same problem. You're also fundraising.
Yes, we're also fundraising.
Okay, fantastic. Look, one last section for today, which I really want to talk with you about, is kind of the overall. Let's take apart climate tech, but the overall trend in venture capital. In the US, we see these massive funds like unresolved. I think they've raised like 10 billion something, or 15 billion, something quite crazy for a VC firm. And then we see the small firms that are solo GPs, 10, 15 million, sometimes up to 50, but like that are smaller and more specialized. And, I wonder, like, are we splitting in two directions there? Or do we also need the 100, 200 million fund that are more generalist? Like, how do you see that working out?
Yeah, I think in the US, it's kind of a different game. In Europe, the mega funds are more like 500 million to 1 billion funds compared to that. But we also have more and more solo GPs. And I think some of them do really great work. And from a return perspective, it also definitely makes sense, because this is very network driven, and they kind of get into deals because of their character and their individual, and because of their network. And it can really make sense from a returns perspective. But of course, they don't have these large reserves or to back these capital intensive companies, and it's rather early stage. So I think for early stage innovation, it definitely makes sense. But
have you ever invested in a solo GP?
No, we cannot.
Oh, you cannot. Okay.
Because we see this as a key person risk. Okay. And therefore, we always need at least two GPs managing the firm.
Yeah. Okay. So what you're saying is that solo GPs do a really great job very, very, very early, so pre-seed, seed kind of stage. What else then do we need in order for that stack to work, basically, right?
Yeah, it also depends on the business models and sectors, I would say, because actually in Europe, we have so many of these 100 million or 200 million funds. This is where most of the funds sizes are at. But it definitely gets harder. And especially also in climate, what I see now is that they are trying to increase their fund size because they see they need more reserves in order to play a bigger role for follow-ons. The business models are capital intensive, lots of deep tech, lots of hardware, and therefore you kind of also need the bigger funds, like 500 plus, because otherwise you cannot play the game.
Yeah. So do you think that we're going to go towards larger climate tech funds?
No, I think it will be both, but or more, there will be these solo GPs and smaller funds more and more, I think. But also the existing climate tech funds or other funds will more evolve towards platforms and larger fund sizes, I think.
Yeah, because so far I think most of the funds have only one fund, basically. They don't have I have a pre-seed and then a seed and then a growth stage fund type of thing. I think that's something that's, as I said, for example, Andreessen Horowitz or others have really 10 different funds they're investing from at the same time, and that allows them to navigate the environment. Whereas feels like for us in climate, at least in Europe, we have one fund and then you invest from that and you try and manage it the way you can.
Yeah.
Well, is there one last thing we haven't talked about that you want to mention on this podcast? Something people should, understand, something people should know from you, from KfW?
I think what people should understand if they're trying to approach us or trying to build relationships, because it's not as easy to get public funding as it seems, because it's also hard to get private funding. But we have such long processes and we have a huge pipeline. And sometimes I think GPs should really be prepared before they approach us. And when I have the impression that they don't even know what we're doing and that we're German, like from the German government backed, and they don't have any German exposure, sometimes I'm really wondering why they're contacting us. So I think it's good if they're doing their homework and if they're around the most important events and industry events to reach out personally. It's always easier, because otherwise it's just you're one out of thousands reaching out every day.
How many funds do you see per year on average, do you think?
On average, I would say 2,000 or so. But there's also many that don't fit our mandates and are just like Indian VC funds or so we could never invest in. But it's a lot, yeah.
Okay, so you basically have the same job as GPs, same process. Cool. Well, without going to an event, where can we find you online? The first way to try and reach out to you is that LinkedIn, email?
It's LinkedIn, yeah.
LinkedIn,
yeah.
okay. Email is not public yet.
It's not public, but most of them find out. It's also not
okay.
NBC. Yeah.
People can also reach out through me if they want.
Definitely.
And then another question for you is, who's next in your seat for an interview to talk about LP investment in climate?
I think it would be interesting to hear the fundraising part from a GP side that just deployed the first fund generation and is currently raising the next fund, like Planet A, for example. And there it could be Lena Tiede, who's GP, but also head of impact. And I would be very curious about how conversations changed now compared to 5 years ago when they raised the first fund.
Sounds good. I'll reach out to Planet A then. They were already a guest twice on the podcast, I believe. But well, fantastic. Thank you so much for today. Had so much pleasure talking to you and learned a lot, actually. So that's great. Any last word for the audience?
Yeah, thank you so much for having me. And I hope that climate tech will be a huge success. And I encourage every LP to invest in this sector.
Sounds good.